On March 21, 1989, in a courtroom in the Southern District of New York, the United States Attorney's Office unsealed a 98-count indictment naming Michael Milken, his brother Lowell Milken, and trader Bruce Newberg. Among the transactions specified was a single bond trade between Drexel Burnham Lambert and Princeton Newport partners. The government described it as having no economic purpose other than to generate a recognized tax loss for the counterparty, with a side agreement that the position would be repurchased at a price making the buyer whole. The indictment ran 110 pages. The trade took less than 2 minutes to execute by telephone. This episode does not address whether Michael Milken committed the offences to which he pleaded guilty. The record establishes that he did. The question is structural. How did a single department within a second-tier investment bank come to dominate an entire asset class? The high-yield, non-investment grade corporate bond, to the point where the same desk could underwrite the bonds, distribute them to a captive network of buyers, repurchase them when those buyers needed liquidity, and direct the proceeds of new issuances back into purchasing the bonds of prior issuers? The mechanism was not a single fraud. It was a closed-circuit market in which Drexel's high-yield department occupied every node. The instrument at the center of this case is the high-yield corporate bond, commonly called the junk bond. A high-yield bond is a debt security issued by a corporation whose credit rating falls below investment grade, defined by the major rating agencies as below BBB at Standard & Poor's or Bar 3 at Moody's. The legitimate economic function is straightforward. A company unable to access the investment-grade debt market or unwilling to dilute its equity can raise long-term capital by offering bondholders a yield premium commensurate with default risk. Pension funds, insurance companies, and specialized credit investors purchase these bonds in exchange for that premium. The market existed before Michael Milken. What did not exist before the high-yield department at Drexel Burnham Lambert was built out in the late 1970s was a deep, liquid, primary issuance market for non-investment grade debt. Before that period, the high-yield market consisted almost entirely of fallen angels. These were bonds originally issued at investment grade by companies that had subsequently been downgraded. The secondary market for fallen angels was thin, dealer-quoted, and dominated by a small number of distressed debt specialists. Milken's analytical insight, documented in his graduate work at Wharton and in early research published during his time at Drexel's predecessor firm, was that the default-adjusted returns on fallen angels exceeded those on investment-grade debt by a margin larger than risk premia alone could justify. The market was mispricing credit risk. Institutional mandates prohibited most large buyers from holding sub-investment grade paper at all, regardless of price. The legitimate business proposition followed from that observation. Build a deep primary market for newly issued high-yield bonds, and three constituencies benefit. Issuers gain access to long-term capital previously available only through bank lending or equity dilution. Investors willing to do credit analysis on individual names capture the mispricing premium. The intermediary, the underwriting desk that organized the issuance and made markets in the resulting paper, earns fees on both sides. By the early 1980s, Drexel's high-yield department, operating out of Beverly Hills rather than the firm's New York headquarters, had built precisely this market. The department underwrote new issues for corporations that could not otherwise access public debt. it maintained a sales force that placed those bonds with a network of buyers, including savings and loans, insurance companies, mutual funds, and pooled investment vehicles. It made a secondary market in the bonds it had underwritten. By 1986, Drexel's share of public high-yield underwriting exceeded 60% in most quarters, according to figures cited in the SEC's later enforcement complaint and in congressional testimony. The fees generated by the high-yield department accounted for a majority of Drexel Burnham Lambert's total revenue. The structural problem was the buyer base. It was not independent of the seller. The same network of institutional purchasers appeared as buyers across successive Drexel underwritings. Several of the largest buyers were themselves financed in part through bonds Drexel had underwritten on their behalf. And in a number of documented instances, Drexel's high-yield department exercised effective control over the investment decisions of nominally independent buyers through warehousing arrangements, undisclosed side agreements, and what the SEC enforcement record termed accommodations. The architecture of the closed-circuit market can be reconstructed from the SEC's civil complaint filed in September 1988. From the criminal indictment unsealed in March 1989, from the related enforcement actions against Princeton Newport partners, and from testimony before the House Subcommittee on Telecommunications and Finance and the Senate Permanent Subcommittee on Investigations. The mechanism operated in distinct but interlocking layers. Step 1. The captive buyer network. The SEC enforcement record identifies a recurring set of institutional purchasers whose high-yield bond portfolios were concentrated in Drexel underwritten paper. The most prominent was Columbia Savings and Loan of Beverly Hills, whose chief executive Thomas Spiegel directed the institution to hold approximately $10 billion in high-yield bonds at its peak, the majority underwritten by Drexel. Another was Executive Life Insurance Company, controlled by Fred Carr, whose general account held an estimated $6 billion in Drexel underwritten high-yield bonds. Additional concentrated buyers included First Executive, Lincoln Savings and Loan under Charles Keating, and a series of pooled investment vehicles organized as limited partnerships with overlapping general partners and limited partners drawn from Drexel's client base. The record does not establish that every purchase by these institutions was the product of an undisclosed agreement, and this episode does not assert it. The record establishes that the same buyers appeared across underwritings with a frequency that, in the SEC's analysis, was inconsistent with independent credit decisions made on the merits of each issue. Step 2. The reciprocal financing arrangement. Several of the largest buyers in the network were themselves issuers of high-yield bonds underwritten by Drexel. The SEC complaint and subsequent enforcement actions established that proceeds from new bond issuances by Drexel clients were, in documented instances, directed into purchases of other Drexel underwritten bonds. The flow of funds did not represent the entry of new capital. It represented the recirculation of existing high-yield capital within a closed network, with Drexel collecting underwriting fees at each turn. Step 3. Warehousing. When Drexel underwrote a new issue and could not place the entire offering with end buyers at the target yield, the bonds were not always retained on Drexel's balance sheet. The record establishes that in a series of transactions documented in the Princeton Newport indictment and in the later Boesky-related enforcement actions, bonds were placed temporarily with cooperating counterparties under an undisclosed agreement. Drexel or its principals would either repurchase the position at a guaranteed price, indemnify the holder against loss, or compensate the holder through other transactions. The counterparty held legal title. The economic risk remained with Drexel or with parties acting in concert with the high-yield department. The Princeton Newport transactions formed the predicate for the first criminal convictions in the broader Drexel investigation. They illustrate the mechanism in its narrowest form. According to the indictment returned in August 1988, traders at Princeton Newport Partners entered into a series of bond trades with Drexel in which the economic substance of the transactions did not match their documentary form. Bonds were sold at year-end to generate recognized tax losses, with an oral understanding that the positions would be repurchased shortly thereafter at a price that made Princeton Newport whole. The jury returned guilty verdicts on tax fraud and securities fraud counts in July 1989. Several of the convictions were later vacated on appeal on grounds unrelated to the underlying transactional structure. Step 4. The use of pooled investment vehicles to absorb issuance the broader buyer network could not. Beginning in the mid-1980s, Drexel and Milken were involved in the organization of a series of partnerships. Entities such as the Otter Creek, Belvedere, and McPherson partnerships, whose general partners and limited partners overlapped substantially with Drexel employees, Drexel clients, and members of the high-yield department's staff. These partnerships purchased equity interests and warrants in Drexel underwritten transactions, often on terms that, according to the SEC's complaint, were not offered to the issuer's other investors and were not disclosed to bondholders. The partnerships served as buyers, as a mechanism for compensating cooperating individuals, and as a means of capturing equity upside in transactions where Drexel's role was nominally that of debt underwriter. Step 5. The linkage to the hostile takeover market. By 1984, Drexel had begun issuing what came to be known as highly confident letters, written statements that the firm was highly confident it could raise the financing necessary for a proposed acquisition. Takeover bidders used these letters to demonstrate financing capacity to target boards and to the market. Because Drexel's high-yield department could, through the captive buyer network, place the resulting bonds with near certainty, the highly confident letter functioned in practice as a financing commitment. This created a structural advantage in the takeover market that competing investment banks could not match. No competing bank controlled an equivalent buyer network. The aggregate effect of these 5 layers was a market in which Drexel's high-yield department acted as underwriter, distributor, market maker, principal investor through affiliated partnerships, financier of the takeover bids that drove issuance volume, and, in documented instances, controller of the investment decisions made by nominally independent buyers. The price discovery function that the secondary market is supposed to perform was substantially attenuated. The marginal buyer of a Drexel underwritten bond was, in many cases, not pricing the bond against an outside option. The next question is how this architecture operated for the better part of a decade without intervention by the gatekeepers, whose function was to detect precisely this kind of structure. The answer requires examination of each layer of the verification chain. The first gatekeeper was the rating agencies. Standard and Poor's, Moody's, and Fitch rated the bonds Drexel underwrote at the time of issuance. The ratings reflected the credit quality of the issuer. They did not, and were not designed to, reflect the structural integrity of the market in which the bonds traded. A bond rated single B was rated on the basis of the issuer's projected cash flows, asset coverage, and capital structure. Whether the buyer of that bond was an independent fiduciary making a credit decision on the merits or a captive purchaser acting in concert with the underwriter was outside the rating agency's analytical perimeter. This was not a failure in any operational sense. It was a structural feature of how credit ratings are defined. The second gatekeeper was the auditor. Drexel Burnham Lambert was audited by Arthur Andersen during the relevant period. The institutional buyers in the captive network were audited by various firms, including the predecessor partnerships of the current Big Four. Audit opinions are issued on the basis of the financial statements presented by management. Where transactions were documented as arm's length and the side agreements that altered their economic substance were oral or otherwise off the books, an audit conducted to the prevailing professional standards would not have detected the divergence between documentary form and economic reality. The Princeton Newport indictment specifically alleged that the side agreements were not reduced to writing precisely because their existence was inconsistent with the documented form of the trades. The third gatekeeper was the buy-side compliance function at the institutional purchasers. In a properly functioning market, an insurance company or savings institution holding billions of dollars in single issuer or single underwriter concentration would face internal pressure from its own risk function to diversify. The record establishes that in several of the most concentrated buyers, Columbia Savings, Executive Life, Lincoln Savings, senior executives directed the concentration personally, and internal risk objections, where they existed, were overridden. For the savings and loan institutions, the relevant regulatory authority was the Federal Home Loan Bank Board, which during the relevant period operated under capital and investment rules that permitted high-yield bond holdings at levels later determined by Congress to have been imprudent. The Financial Institutions Reform, Recovery and Enforcement Act of 1989, enacted after the savings and loan crisis had crystallized, prospectively prohibited federally insured thrifts from holding non-investment grade corporate debt. The fourth gatekeeper was the SEC itself in its market surveillance function. The SEC's enforcement record indicates that informal inquiries into Drexel's high-yield operation began as early as 1986. But the investigation that ultimately produced the consent decree and the criminal referrals originated not from market surveillance. It originated from the cooperation of Ivan Boesky. Boesky, an arbitrageur, had been investigated for insider trading on the basis of information provided by Dennis Levine, a Drexel investment banker who pleaded guilty in June 1986. Boesky's cooperation agreement, executed in November 1986, opened the investigative path into the high-yield department. The structural observation is that the closed-circuit market was not detected through any of the routine surveillance mechanisms designed to detect market manipulation. It was detected because a participant in a related but distinct fraud, insider trading on advance information about takeover transactions, agreed to cooperate. The cooperation produced evidence of the warehousing and reciprocal arrangements that constituted the broader scheme. Absent the Levine-Boesky cooperation chain, the record provides no basis to conclude that the high-yield department structure would have been detected through ordinary gatekeeper function. The fifth gatekeeper, and the one whose failure has been most extensively analysed, was the financial press and the sell-side research community. Throughout the mid-1980s, Drexel's high-yield department was the subject of substantial favourable coverage. The default rates on Drexel underwritten bonds, as reported during the period of active issuance, appeared low. The structural reason the reported default rates appeared low was that the captive buyer network and the warehousing arrangements absorbed paper that, in an open market, would have traded at distressed levels or been forced into restructuring. The default rate was endogenous to the structure. When the structure collapsed, the default rates on the same vintages rose substantially. Studies published by Paul Asquith, David Mullins, and Eric Wolfe in the early 1990s documented the divergence between point-in-time default rates and cumulative default rates by vintage. The cumulative figures, available only with the passage of time, established that the high-yield bonds underwritten during the peak Drexel years experienced default rates substantially higher than the contemporaneous figures had suggested. What would earlier detection have required? The verification chain would have required either a regulator with the authority and analytical capacity to examine concentration patterns across the buyer network as a whole, rather than at each institution individually, or an accounting standard that required disclosure of side agreements affecting the economic substance of securities transactions, or a market surveillance mechanism capable of identifying transactions whose documentary form diverged from their economic substance. None of these existed in the form required during the relevant period. The structural conditions for detection were assembled only after the fact. The unravelling began with Dennis Levine. On May 12, 1986, the SEC filed a civil complaint against Levine alleging insider trading in 54 securities over a period of approximately 5 years. Levine, a managing director in Drexel's Mergers and Acquisitions department in New York, had used an offshore brokerage account at Bank Loy in the Bahamas to trade on confidential information about pending transactions. The investigation originated from an anonymous letter sent to Merrill Lynch in 1985 reporting suspicious trading by brokers in Caracas who were piggybacking on the Bank Loy account. Levine entered into a cooperation agreement. On June 5, 1986, he pleaded guilty to 4 felony counts. His cooperation produced evidence against Ivan Boesky. On November 14, 1986, Boesky entered into a settlement with the SEC under which he paid $100 million in disgorgement and penalties, pleaded guilty to 1 felony count, and agreed to cooperate with the ongoing investigation. The Boesky settlement specifically identified payments Boesky had made to Drexel, including a payment of $5.3 million in March 1986 that the SEC characterized as the settlement of a running account between Boesky's arbitrage operation and Drexel's high-yield department. The nature of that account and the trades it had been used to settle formed a central element of the subsequent investigation. The investigation moved through 1987 and into 1988. Grand jury subpoenas were issued to Drexel, to Milken personally, and to a series of related entities, including the Princeton Newport Partners Arbitrage Fund. On August 4, 1988, the United States Attorney for the Southern District of New York returned an indictment against Princeton Newport principals and 1 Drexel trader, Bruce Newberg, charging racketeering, tax fraud, and securities fraud in connection with the sham trades described earlier. The Princeton Newport indictment was the first to be returned in the broader investigation and served as a structural template for the charges that would follow. On September 7, 1988, the SEC filed its civil complaint against Drexel Burnham Lambert, Michael Milken, Lowell Milken, and others. The complaint set forth 6 categories of violations, including market manipulation, insider trading, false books and records, securities fraud in connection with the failure to disclose the warehousing and reciprocal arrangements, and net capital violations. The complaint sought disgorgement, civil penalties, and injunctive relief, including the disgorgement of Milken's compensation. The complaint estimated that compensation at approximately $550 million for 1986 and approximately $700 million for 1987. On December 21, 1988, Drexel Burnham Lambert agreed in principle to settle the SEC's civil complaint and to plead guilty to 6 felony counts in the parallel criminal case. The settlement required Drexel to pay $650 million in fines and restitution, to terminate Michael Milken's employment, and to cooperate with the ongoing investigation of individuals. The criminal plea was formally entered on September 11, 1989. On March 29, 1989, the criminal indictment of Michael Milken, Lowell Milken, and Bruce Newberg was unsealed. The indictment charged 98 counts including racketeering, securities fraud, mail fraud, and insider trading. On April 24, 1990, Michael Milken pleaded guilty to 6 felony counts encompassing securities fraud, mail fraud, and aiding the filing of a false tax return. The racketeering counts were dropped as part of the plea agreement. The conduct admitted in the allocution included the Boesky stock parking arrangements, the concealment of stock positions held for Boesky's benefit, and the filing of false documents in connection with those positions. Milken was sentenced on November 21, 1990, to 10 years in prison and ordered to pay $600 million in fines and restitution. The sentence was reduced to 2 years after Milken provided cooperation in related cases. He was released in March 1993. The collapse of Drexel Burnham Lambert proceeded on a separate but related trajectory. The $650 million settlement, the loss of Milken and his department, and the deterioration of the high-yield market through 1989 produced a liquidity crisis at the firm. By February 1990, Drexel could no longer roll its commercial paper. The firm filed for bankruptcy protection on February 13, 1990. The bankruptcy proceedings extended into the mid-1990s and established through claims reconciliation and trustee investigation the full scope of the high-yield department's market position. At the time of the filing, Drexel's inventory of high-yield bonds and bridge loan positions exceeded $1 billion, much of it in issues for which the firm had been the sole or principal market maker. The collapse of the firm produced a secondary collapse in the high-yield market itself. With Drexel's market-making function eliminated and the captive buyer network simultaneously under pressure from regulatory and solvency constraints, prices for many high-yield issues fell substantially in the first half of 1990. Executive Life Insurance Company was seized by the California Department of Insurance in April 1991, and its high-yield bond portfolio liquidated at distressed prices. Columbia Savings and Loan was placed under regulatory supervision and its bond portfolio similarly liquidated. The cumulative default rates on the 1986 through 1988 vintages of high-yield bonds, as documented in subsequent academic research, exceeded 30% on a cumulative basis through the early 1990s. The findings of this case, as established by the closed enforcement record, are these. First, the high-yield bond market as it existed in the United States in the mid-1980s was not a market in the price discovery sense the term ordinarily implies. It was a closed-circuit distribution system in which the underwriter occupied a dominant position at every node of the transactional chain. The yield premia at which bonds traded in this system did not reflect independent credit assessments by marginal buyers. They reflected the terms on which the underwriter was willing to clear the market. Second, the verification chain. Rating agencies, auditors, buy-side compliance, regulatory surveillance, and financial press did not detect the structure through any of its routine functions. Detection occurred through the cooperation of a participant in a related but distinct insider trading scheme. This is a structural finding, not an attribution of blame. The gatekeeping mechanisms were not designed to detect coordinated activity across nominally independent market participants. The disclosure standards then in force did not require the documentation of side agreements that altered the economic substance of transactions. Third, the regulatory response was substantial and specifically targeted at the structural conditions that had enabled the closed-circuit market. The Financial Institutions Reform, Recovery and Enforcement Act of 1989 prohibited federally insured thrifts from holding non-investment grade corporate debt, eliminating one of the largest pools of captive buyer capacity. The Insider Trading and Securities Fraud Enforcement Act of 1988, enacted while the Drexel investigation was ongoing, increased civil penalties for trading on material non-public information and established controlling person liability for supervisory failures. Securities Act Rule 144A, adopted in 1990, formalised the institutional private placement market in a way that, while expanding access to high-yield issuance, also subjected it to clearer disclosure expectations. The SEC's market surveillance function was reorganised to give greater priority to cross-market and cross-participant pattern analysis. Fourth, the high-yield bond market itself was not eliminated. It was reconstituted on a different structural basis. The post-Drexel high-yield market is characterised by multiple competing underwriters, a diversified institutional buyer base, mandatory disclosure of material side arrangements, and rating agency methodologies that incorporate concentration and liquidity factors. Default rates on subsequent vintages, while cyclical, have not exhibited the divergence between contemporaneous and cumulative figures that characterise the 1986 to 1988 issuance. The structural observation that emerges from the closed record is this: market integrity is not a function of the honesty of individual participants. It is a function of the architectural separation of roles within the transactional chain. When a single entity occupies the positions of underwriter, distributor, market maker, principal investor, financier of the demand side, and counterparty to the buyers it has organized, the price signals generated by that market do not contain the information that prices in an open market are supposed to contain. The Drexel High Yield Department demonstrated that this concentration of roles, once established, is capable of sustaining itself for an extended period through the recirculation of capital within the closed network. Detection depends on conditions extrinsic to the routine operation of the gatekeeping function. The record is closed. The findings stand.